Good morning, everybody. I have the privilege today to talk to you about the very exciting topic of news patterns and how it impacts the way we construct sentiment trading strategies, as Armando pointed out. But first, I'd like to say that it's great to see how the RavenPack events are growing year after year, which I think is a strong testament to the increased focus in the marketplace that we see on big data and AI in general. And I think it's a focus which is well deserved, as they both contribute to the ongoing disruption of the investment industry. And if we turn to alternative data in particular, it has allowed investment managers to move beyond more traditional and perhaps somewhat stale fundamental data that is being consumed through more traditional fundamental databases. And we can also see alternative data helping more market-based, market data-driven signals, price-driven signals, allowing you to split or to distinguish between signals that may be driven more of market behavior versus signals that are, can you say, or price moves that are driven by updates to fundamental information or expectations or changes in expectations of these fundamental data. If we look at being able to extract value on unstructured content, or being able to extract value from unstructured content like news and social media, as well as analyst reports or earnings transcripts or legal filings using natural language content, is by many considered one of the biggest disruptors in finance and investing in years, and it has opened up a completely new avenue for alpha generation. As part of this, can you say, revolution, RavenPack has proven itself as one of the pioneers since we launched, or since we were founded back in 2003. And especially within the news analytics space, we have been, can you say, contributing to the space since we launched the first product more than a decade ago. And I think today, news analytics stands as one of the cornerstones of the alternative data landscape, given its wide range of practical and proven use cases and the deep history available for backtesting. Something which stands in sharp contrast perhaps to many other alternative data sets out there that may to some extent, or at least some of them, are somewhat overhyped. As investment managers or investment firms are turning their attention to alternative data, I think it's important to think about how the data is being generated in the first place. Because it often is important in order to understand how can I take best advantage of it. We may be exposed, or we need to learn about new microstructures of this type of data or new seasonality patterns that could influence how we construct our trading signals. For instance, if you look at news, we are, of course, very much impacted by the earnings season. There's no doubt, of course, that earnings news takes up a large proportion of the information available out there, but you also generally see that companies communicate more through the earnings season. And you also see analysts, for instance, updating their recommendations on what stocks to buy or what stocks to sell based on the new information that is being communicated or that becomes available through the earnings season. But we're also seeing, can you say, dynamics that impact more of an intraday news pattern. And that's really where I will have most of my focus in my presentation today. And one of the things which is most obvious is press releases. Press releases is, of course, when you have companies communicating with the marketplace, and often they go into embargo before they are being released, and therefore tend to be released at certain times during the day. And that creates very unique intraday patterns that you can take advantage of when you create your trading signals. One of the things that we're also seeing that, in contrast to with market data, news is also available in an uninterrupted fashion, 24 hours a day, 7 days a week. And when we look at even a daily trading strategy, it may be that we shouldn't necessarily listen to all of the information available out there. It may be okay to leave some information on the table when we construct our sentiment signals. It might not be optimal, for instance, just to default to a 24-hour aggregation window when we create our sentiment signals. Instead, we should try to understand, as I mentioned before, how what the impact is of news as they're being reported, both during and outside of market hours. So let's take a look at what an average intraday news pattern looks like. What you can see here, it's quite clear that there are two distinct news volume spikes during a 24-hour period. You'll see a massive spike in the pre-open, so in the hours before market open. In this case, we have focused on news around Russell 1000 companies, so focused on the US market. And you also see a massive spike after the market close. So it's a large proportion of all the information which is available is actually happening outside of market hours. What we also find is that different news groups or news categories have different intraday patterns. One which is perhaps most striking here is if you look at the red color, which represents insider trading information. It tends to mostly appear or occur after market hours, where you have, let's say, earnings information or analyst information more scattered throughout the day, but of course still contributing highly to the news spikes that we observe. And can you say, looking at these various distributions, perhaps we can exploit that to construct signals through the use of different look-back windows and potential snapshots for our trading strategies. So in order to learn more about how we can take advantage of these patterns, as part of one of our recent research papers, we came up with a simple use case. We look across a simple benchmark universe, the Russell 1000, as I mentioned before. And we test or look at the backtesting period from January 2007 through July 2018. And we take advantage of RavenPack's event sentiment score, which is available across almost 7,000 different types of events that we detect in the news. It could be anything from earnings-related news to analyst ratings, insider trading, some more traditional types of information, but also looking into corporate actions, M&A activity, etc. And we take a sum of sentiment across highly relevant and highly novel news events. Also analytics available as part of the RavenPack feed. And in order to construct our indicators, we also subtract the daily cross-sectional average of sentiment in order to remove any sentiment biases. Something that we have shown as part of our research helps in creating stronger signals. And then finally, to kind of evaluate the intraday patterns, we create various sentiment indicators based on different look-back windows from 1 hour up to 48 hours. Just first, we wanted to take a look at or try to track performance on a quintile, from a quintile perspective. So averaging our signal or exposure for each quintile to see if we get some nice behavior from the sentiment indicators on their own just to get started. And what we see is that we actually see a quite nice pattern. So we see that more extreme sentiment stocks tend to lead to greater price impact. And we see that it's more like a trend following or momentum type of signal, that positive sentiment leads to outperformance and negative sentiment leads to underperformance. So we try to take advantage of that, of course, as we build our sentiment strategies. We create a set of long-short strategies. We use sentiment weights, so the more extreme the sentiment, the greater allocation we make. However, we also apply a 5% maximum allocation constraint, just to ensure some level of diversification, as well as, preventing us from having too targeted portfolios in situations where we have, on days we have a few signals. And we also define a set of entry and exit timing rules, 4 different ones. We create strategies that consider open-to-open type strategies. We create one that does an open-to-close, so purely focused on, the intraday behavior, price impact. We also create a strategy that looks at close to open, so taking an exposure overnight. And then finally, we create a close-to-close strategy. And we cut sentiment. When we create our open-based strategies, or entry at the open, we cut sentiment just before the market open. When we create sentiment strategies around the close, we cut it half an hour before the close. And from an entrance and exit point of view, we use 30-minute VWAPs. So we use 30-minute VWAPs just immediately after the open when it's an open strategy, and when we treat the close, we take a 30-minute VWAP just before the close as well. So if we take a look at the various strategies and how they perform from an annualized return perspective, it is quite clear from this particular picture that the open-to-open strategies outperform any of the other strategies. Of course, not all of them have the same holding period. Some only take the overnight, some only take the intraday. But if you look at the open-to-open and the close-to-close, they have the same kind of 24-hour holding period. But it's pretty clear that the open-to-open, as I mentioned, outperforms the rest. And when we look at what windows we need to use in order to maximize returns, we find that for the open snapshot, a 4-hour window seems to be optimal. However, if you look at the closed snapshot, we need to consider a 10-hour window. And what's also interesting to see is that we see a consistent decay in performance as we increase our aggregation windows beyond these optimal points, which is, of course, because we start to put more emphasis on old news. So to kind of get a sense for an understanding of why are the 4 hours and the 10 hours optimal, let's try and take another look at the intraday pattern that I showed you previously. Now shifted according to the open. So the open here is represented by the 0 on the x-axis right at the far right side of this graph. And what you can see is that the 4 hours basically captures the massive spike that you see of information just before the open. So it seems as if the open news volume is very informative when it comes to, can you say, next day or the next few days price moves in the market. There is, of course, a potential 18-hour window as well that we might want to consider, because that will allow us to also grab the other available news spikes just before the market close. And what we find is that in some cases, that may be what you want to do. For instance, if you wanted to build an insider trading strategy, an 18-hour window is exactly what you want to do, because otherwise you won't have much volume supporting that particular type of strategy. What we also find is that if you start to move outside of a large cap universe, you may also want to expand your window. For instance, if we look at the Russell 2000, we still optimize return if we use a 4-hour window, but if we consider, or if our objective function is shifted more towards optimizing information ratios, we want to expand our window because small caps, of course, have less news than large caps, and therefore you're able to create larger portfolios and get additional diversification benefits by expanding the look back. If we look at the same kind of analysis, but now shifting the whole distribution and towards the close, we can see why, or it becomes obvious why a 10-hour look-back window is the optimal one. We still capture the 4 hours of pre-open news. And similarly with the 18 hours, now we have to go back 24 hours in order to capture the after-close news if we create signals. And I think what's interesting here is that it's pretty clear from those two pictures, the shift, that if you trade the close snapshot as opposed to already starting creating your signals around the open, on average, you trade further away from the news. So that's why it seems quite obvious that the open strategy type-based strategies will outperform. On this particular picture, we have tried to look at it in a slightly different way to try to get a time series perspective to it. So we try to plot the cumulative returns of the two strategies, the open-to-open on the left side and the close-to-close strategy on the right-hand side. And you can see that there's a significant shift in performance between the two. Of course, these do not incorporate any sorts of transaction cost or look at scalability or anything like that. But it's still a quite interesting way of looking at it, that you basically can get 1 day earlier into prices or into the stocks if you trade the open. And I think what's also interesting is that, and something we have highlighted in yellow, is this standard default view of just saying, I want to incorporate all information out there. So I'll take a sum or include all sentiments. So I look at my 24-hour window. You can see that you have quite significant boosts moving from 24 hours to 4 hours. And even if you look at maximizing information ratio, which is what we have highlighted with the green line, you can see that the maximum information ratio is also generally achieved with shorter look-back windows that are represented by the more dark-colored lines. One of the things that have to be taken into consideration, of course, when we look at these strategies is that they are based on 30-minute VWAPs. And of course, there may not be enough liquidity to really trade it at scale. So we also try to look at what would happen if we expanded the execution window towards a full-day VWAP. And of course, there is a cost here. You are losing something on return, and you are losing something on information ratio. And on this picture, I try to highlight kind of what kind of cost or loss can we expect. On the left-hand side of both the annualized return graph and the information ratio graph, we have included the official open price. And of course, that's not tradable at scale in any way, but it's there as a benchmark. And even moving to, let's say, a 30-minute VWAP, you can see that there is a significant reduction in performance. We go from about 35% to about 25% as we take, can you say, a more realistic entry price. And as we expand towards a full-day VWAP, we end up with annualized returns of about 18–19%. If we look at the information ratio, the cost is a little lower. So with a 30-minute VWAP, we look at about 3.1 information ratio, and it ends up about 2.8 if we use full-day VWAP. And I think what's very interesting here is that even when we execute with full-day VWAP prices, a full-day VWAP, we outperform the standard 24-hour close-to-close strategy. So it seems that we definitely get some benefit in taking into consideration the, can you say, the intraday news volume patterns when we try to figure out how to execute on these type of strategies. So just to conclude, and before I open up for questions, I think the key point that I want for you to take away from my presentation today is that when you move, can you say, from more traditional sources of information and into alternative data, that you should be careful about making, or default to some basic, perhaps quite intuitive ways of looking at data, but trying to really understand the patterns of how the data is being generated. And we kind of showed, we kind of used the example of news patterns to show that they very much dictate how one should implement at least sentiment strategies. And we found that opening sentiment snapshots significantly outperformed closing snapshots due to the closer news proximity. And also we found that the 24-hour sentiment aggregation window, or deviating from the 24-hour sentiment aggregation window, can lead to both improved annualized returns and information ratios. And one of the things that we are working on right now is trying to include more asymmetries and not, can you say, take the average view, try to figure out what are the optimal windows when it comes to different event groups, but also across various sources. Because we can also see that these news patterns are different when you go to premium newswire services, which have very distinct, like Dow Jones, which have very distinct intraday patterns, as opposed to when you go to more web-based sources where the news volume distributions may be more evenly or more distributed over the entire day. There will be more research out on those type of things in the future. But at this stage, I'd like to open up for questions if there's anything in particular that you would like to hear more about.
Thanks for raising your hands. Someone will Great, thank you. I guess this question could be also for Armando. Armando, excuse me, mentioned earlier that I think you made an interesting comment that you saw an uptick this year, fundamental analysts becoming interested in alternative data sets. I have heard similar comments from other alternative data providers. That's also for Peter as well. Can you share your thoughts? What changed the mindset and what's the rationale from sort of the fundamental guys? It's hopping on the quantitative side also. What's the mindset? Why is there a reason for shift and the reason for that? Thank you.
I think definitely there's been, can you say, we have gone from a wait and see to a little bit like, the whole space as being, of course, more hype, there are more conferences and so on. So people start to get to a situation and say, okay, it's a space we have to be in because otherwise we're going to be left behind. And I think that shift has really happened now, that people have realized that they need to make investment in this space and educate themselves. And of course, there's also that fear of being left behind. But I also think generally the market has become a little more educated. And we saw the same thing when we started out in the quant space when it came to alternative data, that I tend to say that in early days, the market was in need of education, and then it became inspiration, and now, of course, the most sophisticated funds are well ahead in terms of applications of these type of alternative data sets. And the fundamental space is going through that same cycle, right? They're probably still, to some extent, in education space, they are now ready to kind of approach or think about alternative data, and then they will have to spend a few years to kind of learn how to take advantage of it within their framework.
Just a quick follow-up.
Sort of similar question. When did you see the initial interest from the quantitative analysts becoming interested in the alternative data sets, really beginning sort of what the fundamentals seeing now? When did you see it? Was it 2011, 2010, 2012? When did you see it? Thank you.
I would say we signed up our first clients already back in 2007, 2008. But of course, I would say a massive shift where it was perhaps more broadly applied, probably 2009. And then, of course, it's just been exploding since that point onwards.
My question is, I've read and would urge everyone else to read first to read the news analytics and algorithmic trading, which is a terrific third-party testimonial on the value of your news analytics. The speaker up front, I'm to your left-hand side. So I would urge you all to read that. It shows the impact of RavenPack's news analytics on the market. But if you're not a high-frequency trader, are you at risk of using one of these products and having your potential alpha arbitrage away by an HFT? That is, if you have a holding period literally for more than 5 seconds, will this kind of fantastic news analytics that RavenPack provides be sustainable in terms of a portfolio construction?
Yeah, I think the study that you're referring to was quite interesting, INSEAD Wharton paper, and looking at how RavenPack itself is information. How RavenPack covers news is information on its own. I think from most of the testing done on our data, people, at least early days, when we started out 10 years ago, the view was that this is really a high-frequency signal. But it's not. Of course, it's high frequency when if you are used to, let's say, 1 or 2 or 5 years investment periods. But it's not measured in seconds or minutes or perhaps even hours intraday. The sweet spot is really measured in days up to a couple of weeks, or depending on the trading universe that you are focusing on. We're not seeing, can you say, that you are being picked up or being picked on from the high frequency guys. That's not really where we have most of our clients. Most of our clients are operating in a statistical arbitrage space and perhaps more in more traditional asset allocation type of strategies. And I think this game is not about speed, it's about smarts. It's about how you take these type of data sets and combine it with other types of information, often to create more complex hypotheses that are not what you will traditionally do in the high frequency. It's more about being fast and having fairly simple signals in many cases.
This is RavenPack.